Hello everyone, and welcome to Module 12 in our Forex Master Course. I'm happy you have reached this far, and really, at the end of this lesson, you will just be you will be just ready to start the journey in trading. In this lesson, I'm going to introduce you to investor psychology. And most folks will just fast forward through this video and get to the juicy stuff. But let me tell you, this is the holy grail here. Investor psychology and risk management is the holy grail of trading. And the whole point of this course is to get that get that deeply rooted in your psyche. At the end of this video, we will then be going on to the advanced modules. So after the first 12, we'll be going on to the advanced modules, and we're going to focus on investor psychology, trading system development, and really learning the tools that you need to start trading successfully on your own. But investor psychology is extremely important. Okay. Now, this video is not really very long as it's just an introduction to investor psychology. But the biggest enemy to having success in the market is yourself. To be successful, you have to approach the markets with a ruthless, cold as ice approach. And emotions must play no part in your trading decisions. I know you probably have heard a lot of these things already, but they are so true. The reason why most traders don't make any money is because the market defeats them. The market defeats them psychologically, and it's your job to not let the market get the better of you. You have to be on top of the market, and there are certain rules that we're going to talk about that will allow you to have the greatest chance of being successful in the market. Okay, so number one, to be successful at trading, you need to be highly disciplined. If you are an indisciplined individual, you need to find a method or find a tool to make you disciplined. For example, if you set up a set of rules for trading, you cannot deviate from those rules. Do not make exceptions, quote unquote, this time, or this time will be different. No, it won't be. Define some rules, and we're going to speak about that in advanced modules. You have to define some rules and you have to stick to them. It's a part of being disciplined. In the markets, there is no room for indisciplined traders. Very important. You need to set up clearly defined trading rules. As I said before, most traders out there have no rules for trading. There are no specific rules to enter the market. There are no specific rules to exit the market. There are no specific risk management rules. There are no specific rules to take profits. There are just no rules. The typical trader out there wakes up, they look at the market, they say, oh, I think the euro or the British pound may go up today, and they trade based off of emotions and not specific rules. And at the end of the advanced modules, the whole goal and the whole point of of the training is for you to have specific rules that you can write down that will define your very own trading system. And we are going to go through that. And what you will need to do also is you'll need to evaluate if your rules make sense. Your rules have to make financial sense. So it doesn't make any sense for you to develop rules and trading systems that aren't profitable. You have to first ensure that your trading system is profitable, and then your challenge is to stick to the system. And again, we're going to speak about trading system development in the advanced modules. Again, we said you need to stick with those rules. Okay. Now, the reason why, let's look at the reasons why traders don't stick to the trading rules. Number one is fear. Traders have a reluctance to pull the trigger. They fear trading the market. And the number one reason for fear in the market is the reluctance to lose money. And we're going to speak about that later. So fear, reluctance to pull the trigger. And a lot of traders may say, let me wait and see what happens. It's an emotion that it's a procrastination type of thinking that happens to all of us. In the back of our mind, we may see a trade and we get an uneasy feeling, and we may say, let me just wait and see what happens. Let me not enter that trade now. What that is your fear. And you have to find a way to overcome that fear. And I will have some recommendations about how to overcome your fear. And the fear of losing money. Now, money in life is very important to folks. There's a saying that if you want to keep your relations with your family members and friends good, you don't enter business with them. And that is so true, because money, when it comes to money and people's money, they take it very seriously. And there is a fear of losing money. Everyone fears losing money. So this is the main reason why traders don't enter the market or don't follow their trading system, because they are afraid. They are afraid of losing, they are afraid of trading, and it stems from not having confidence in your system. So this is something that you have to work on. And how I recommend working on your fear is reducing your contract size and your trading account. If you can trade, let's say you have 20,000 or 25,000 to trade US dollars. I would recommend you trading 1,000 of that yourself until you can get that profitable. If you can't make money on $1,000, you won't be able to make money on 10,000 or 20,000 or 100,000. Because the more money you have, you will find that your losses in the market will get greater in terms of percentage. So let's say if you have a system of losing 1% per trade. 1% of $1,000 is $10, while 1% of 100,000 is $1,000. So it's easier for us to lose $10 rather than lose $1,000. And once you're able to make money on the $1,000, then you can step up to trading larger account sizes. And I'm going to speak briefly about losses. Losses are a part of trading and cannot be avoided. There is no trading system in this world that doesn't experience losses. Actually, some of the best trading systems out there have only a 30% win rate. So that means 70% of their trades are losing trades. There is no one out there in the world that has 100% track record when it comes to trading. So losses are a part of trading and cannot be avoided. Now, it may be good to watch this video a couple of times, because it's out there and people say that losses are part of trading, and you may hear it, but it's not deeply rooted in your psyche. You don't understand it completely. And once you understand that you must have losses, then you will start to separate yourselves from the crowd of traders who are trying to avoid losses. Again, people try to avoid losses because of fear, but losses are part of trading and cannot be avoided. Think of losses in trading as inventory. If if you have a fast food restaurant, you have to buy the raw materials, you have to pay electricity, you have to pay your water, you have to pay for the food, you have to pay the cooks, you have to pay people. Those are the expenses associated with a business. So your trading business, your losses are, you can think of them as your expenses. And the trick is not to let your losses be higher than your gains. Drawdowns are a part of trading and cannot be avoided. We need to get that in our heads also. A drawdown is defined as a series of losses, and you're swinging equity. So for example, you may start trading with $10,000, and you may find that after a couple of losses, your account drops to 9,000 or 8,700. That is a normal part of trading. Well, it depends on your risk, but drawdowns do occur. There is no trading system in the world that makes money consistently in terms of your equity curve just goes up. Let me, okay, for example, there is no equity curve that just goes up like that. So if your account is at 10,000, or your starter trading account with 10,000, when you look on your account month one, it won't be 11, then 12, 13. It just won't go up in a straight line like that. What may happen is that, depending on your system, your account may dip at first, then it goes up, then it dips again, and the dips are the drawdowns, and it should go up again, and then it dips again. Then it may remain stagnant for a while, it may even go down further, then it may go up, dip, stagnant, go down further, up again. So all of these dips down are your drawdown, and they occur all the time, and they will occur often. The trick is for you to manage the drawdowns properly, so that you don't end up having large losses. So drawdowns are a part of your trading. So let's say this is 10,000, and this is over the period of a year. You may find that, let's say you had a good year and you made 60%. This is 16,000. So the road to 16,000 is not straight up. It's very bumpy. You will have ups and downs and periods where nothing happens, further losses by ups, and that's what your trading system should do. Have higher highs, higher lows, an uptrend. I hope that looks familiar. So that's how your equity will swing throughout the year. Now, another thing, if a trade goes against you and you followed your system, you did nothing wrong. This idea of you are wrong, you weren't wrong. You followed what your system told you to do, and the market went against you. And there's nothing wrong with the market going against you. Eventually, if you design your trading system and your trading rules properly, you know that eventually the market will go with you and will go in your direction, and you will ultimately profit. Um, and in the advanced modules, we are going to speak about this extensively. Uh, this idea of you did something wrong. No, you didn't do anything wrong. The market just went against you, and you have to manage your positions properly when the market goes against you, and maximize the gains when the market goes with you. Now, greed is another emotion that you have to overcome. You will have a feel, let's say you have a string of winning trades. You will then feel invincible. You will think that you are a genius. And what normally happens when you get greedy is you risk too much money. Again, it goes back to you being not disciplined. Greed, when you see that your account is going up and going up, you may be tempted to risk too much and deviate from your trading system. Again, the common theme is deviating from your trading system. You have to do everything in your power to stick with your trading system. I cannot stress that. I cannot stress that enough. And there are two elements to profitable trading: designing a system that's profitable and sticking with it. And if you can do those two things consistently, you will make money in the markets, and you will have a very fruitful future in the markets. If you cannot do those two things, then if you cannot design a system that is profitable and you can't follow it, well, you will definitely not make any money in the markets. So greed comes in when you risk too much money and the market goes against you, and you find that you have a huge loss. And sometimes it's difficult coming back from large losses. For example, your system may say you risk 1% per trade, and you analyze the market and you see a quote unquote sure thing trade. This trade, you say it just has to work. The stars are aligned. Everything is going your way. And what you may do is say, okay, let me risk 30% on this trade or 25% on that trade. And the trade goes against you. And then you see that you have a large loss in the market. Some of us may even in the past have even risked 50% on the trade or 70% of your money on the trade. And that when that trade goes against you, then you will have a large loss that is almost impossible to trade out of. So do not risk too much. Be mindful of the fact that you will get greedy. Again, your emotions will come in. Your emotions will play a part in your decision making. And your emotions ultimately will defeat you. So you have to determine also, are you mentally fit to trade? And we are human beings, and there are certain things that may cloud our judgment when it comes to trading. For example, a recent job loss. If you have a job and you have lost the job, you may be feeling down, you may not be thinking clearly. So you have to always assess whether you are mentally fit to trade. Death, I mean, all of us have experienced someone close to us that has died. So when you have experienced a death recently, it may cloud your judgment, and the best thing may be not to trade during that period. Financial trouble. Again, if you are going through financial stress, when the money that you lose in your trading account is amplified even further, and you start to do things that sabotage your trading if you are in financial trouble. Divorce, common thing that happens, and it can affect your trading. And a string of losses in the market. Now, again, string of losses happen and you experience a drawdown. What will happen? Emotionally, you will feel bad. The market, and it's always a challenge to not let the market get the best of you. Remember, if you are if you don't have your emotions in check, the market will defeat you. So, and if you are not disciplined, the market will defeat you. And after a string of losses, you may find that you, let's say you have 5 losses in a row. You see a next trade, a good setup that your system said, okay, enter this trade. And after those 5 losses, you have been hurt, quote unquote, hurt by the market. You may not want to enter that trade, but that trade may be the winning trade that makes up for those 5 losses and actually put you in a profitable situation. So if you didn't take that trade, you wouldn't be profitable. If you didn't take the trade, you wouldn't you wouldn't have gotten that large win, and you wouldn't be profitable. And if you took the trade, you would be profitable. So just remember, you have to stick with your system. Stick with your system. It then comes back again to being disciplined in the markets. I know I'm saying a lot of this, and you may say a lot of this is theory, but it's very important, and it is a lifelong struggle for you to develop that discipline. Some of us may find it easier than others, but you just have to develop that discipline. Stick with your system no matter what, because the system that you have come up with is a system that you have back tested, that you have done research to know that it's a good system. And in the advanced modules, we are going to speak about trading system development. So, psychology again, always follow your trading system. And the problem out there with many traders is that they don't have a trading system. Now, for those of you who have traded and who haven't traded, who haven't experienced success yet, can you honestly answer the question that you have developed a system to trade? And number two, can you honestly say that you have followed the system 100%? You're trading at the end of your trading year, or whatever period you choose to evaluate yourself, you should have a score that, okay, what is the percentage of trades that you took that your system fired off? Did you stick with the rules of the system? And you have to give yourself a grade. If that grade is 95, 90 and above, that means you probably would have a profitable year. If it's below that, then the year might have been shaky for you. So always follow your trading system. And the problem is most traders don't have any trading system, and that's why they are not profitable. So we're going to be speaking about investor psychology further in the advanced modules, but I just wanted to introduce the concept of investor psychology, and we're going to then develop certain ideas about the market in the advanced modules. And the whole point is to then finish up with advanced investor psychology, where we'll come to certain conclusions about the market. And once you come to those conclusions and recognize those quote unquote facts about the market, then I believe that your trading will take off, and you will then be in the realm of the advanced trader, and you will be in the realm of the profitable trader. So please listen to this video again if you want to go over it. But just remember, psychology, investor psychology, is very important. I would say psychology and risk management are the two most important things when it comes to trading, and then your method is number three, because there are many different methods that traders use to trade the market. But really, the question is, can you stick with that method, and do you have good risk management? So we have spoken about that extensively. Now, congratulations on finishing the first 12 modules. These 12 modules were just the basic modules, uh, and that you need to master. And then we're going to go into the advanced training. So if you're having any questions about any of these modules, please send me an email at beyond@acestrading.com. Go over the lessons, and make sure practice your market analysis, and go over the concepts that we went over, and then you will be able to proceed to the advanced modules. Thank you very much for listening, and congratulations for finishing part 1 of the course. Thanks.